welcome to episode 96 of Mo Money, the investing and economics show for millennials by a millennial, where our goal is to educate, entertain, and increase the financial literacy for a whole new generation of investors. I'm, of course, your host, MC Mo. Now let's get to the money. This week we are going to discuss IPOs.
An IPO is an initial public offering. It's the first time a stock is offered for sale to the general population. Now, as the firm taking the company public, we set the initial sales price, then sold those shares right back to our friends.
The first 8 seconds were a good explanation, then it gets into the shady shit. IPO day is a big day for a company. It represents that they made it, that they're no longer the startup company who has to depend on venture capitalists and seed money to fund their companies anymore. They can now receive this huge influx of cash from the general public, which the company can use to expand their business, hire better employees, or whatever they feel they need to do to make the company better and more profitable. But this video is not meant to be so much about initial public offerings. It's more about why you should not buy them, but why you should be cautious when it comes to buying. There have been some large IPO names in the past couple years, companies that we all use and we all enjoy. Spotify, Uber, Lyft, Etsy, Roku, Fiverr, Snapchat, just to name a few. All IPOs have underwriters, which are investment banks like Morgan Stanley, JP Morgan, Bank of America, Goldman Sachs. They serve as a middleman between the company and the general public. They help the companies decide how much money they should be raising, the IPO price, and they also sell the stocks for them. So there is incentive to hype up the IPOs, just like there is an incentive for any company or organization to run a huge ad campaign when they have something new to offer. Try our new burger. Come visit Nashville. See Cory Booker on the RuPaul show. You want to create an excitement around these products, places, and candidates because you want the attention, and ultimately with that attention comes the money. When it comes to IPOs, it's no different because companies and the investment banks both want the attention and they both want the money. If there is neither, then nobody will buy the stock, and the investment bank is stuck with a bunch of stock of a company nobody wants, and the company is left receiving less money than they planned for. A real lose-lose situation for both parties. So both of these groups run ad and publicity campaigns to create hype and excitement about the company. Company executives will go on business channels and hype up their business and get people excited. They'll run commercials and all other forms of marketing campaigns. Investment banks will call on their clients and try to drum up excitement about the upcoming IPO and offer them shares on IPO day, because when it comes IPO day, you want to have people who you know about it and can call and sell it to. And for the most part, it's pretty easy to do, especially with popular companies. Hey, I use Spotify every day to listen to music, and so do my kids. Yeah, I'll buy this stock. I take Uber everywhere when I'm visiting or I'm out drinking. Sure, I'll buy this stock. I'm a vegan, and saving the earth is important to me. Sure, I'll buy Beyond Meat stock. It's that easy. The problem with this, it creates euphoria and mania, and people get so excited that they just buy the stock without much thought. The average price increase for an IPO since 2010 is about 23% on its first day of trading. So people are making money and the stock is going up. Why shouldn't I buy it? Well, when a company is private, it does not have to share much information at all with the general public about their revenues or their expenses. That all changes when the company becomes public. So when a company goes public and the numbers are released to the general public, these great companies that you love might not seem so great anymore, at least in terms of actually owning their stock. They might show that they're burning hundreds of millions of dollars a year and their revenues aren't increasing at a pace to keep up with that number. When the market realizes things like this, the euphoria and excitement wears off and the selling begins. In March 2017, Snapchat had their IPO day. The stock opened at about $17 a share and closed the day with a 44% increase, around $24 a share. But within a year, the stock was down over 40% off of that high. Facebook in May 2012 closed only 23 cents up on its IPO day. Within 6 months, it was down 50%. And Twitter in November 2013 had a 73% surge on their IPO price within the first day of trading. Within a month, it was up over 150%. Now today, 6 years after its IPO, Twitter is still 47% below that initial high. Other examples of coming off that 6-month IPO high, GoPro is 93% off its high still. Fitbit, 90% off. But it's not all bad. In 2017, Roku IPO'd at $14 and is now $102 a share. Etsy IPO'd at $16 and sank to $7 in a few months. It's now $67 a share. Uber IPO'd at $45 and sank 10% in the first couple weeks, but is now back at $43 a share. Lyft IPO'd at $72 a share, quickly sank to $52 and is now back at $60. Still 16% below its IPO price just a month ago. Bottom line, I always say buy what you know. Warren Buffett said never invest in a company you cannot understand. Pretty much the same thing, so don't take my word for it, take the billionaire's word. The thing is, just because you use it or you know about a product or a service a company offers does not mean you know the company, at least in terms of financials. Someone who's saving for retirement, the last thing you want to see is wild volatility, especially if that means a 50% drop in a stock in 6 months. These first few months or years for a new young company are when they're getting their sea legs. They're making adjustments, expanding, and doing other things to improve the company. They are in a different league now, and they need to adjust, which leads to these price swings, because now they have other shareholders who may get upset and try to change things within the company. That is why I always suggest waiting when it comes to these new companies, especially tech companies, until they have proved themselves able to properly run their companies, increase their revenues, decrease expenses, and to expand and compete. I don't teach people how to trade stocks here. I teach them how to invest for the long term. So when a good company comes along, a company which has a stock worth buying, the stock will give you a chance to buy it. There's no need to rush because you don't want to miss out. In other words, as is always, good advice when it comes to investing, just be patient. Thank you so much for watching another episode of Mo Money. You can find new and classic episodes right here on YouTube. For now, don't forget to like, comment, subscribe, and share. Follow me on Twitter, follow me on Instagram, like me on Facebook.
Mo Money, signing out.